Good afternoon. I am Jermaine Hadaway, and this is Church Pension Group's Insights and Ideas Conversation, Investing in Economically Disadvantaged Communities. Without any further ado, I'm going to turn it over to Reverend Canon Ann Maloney for opening prayer.
Hello, everyone. Let us pray. Dear God, we gather in a time when news of the urgent and the immediate command our attention. Today, we want to shift our focus to the long view, specifically on a vision of stronger communities where everyone can thrive, and how we can use the resources with which you have entrusted us to make that possible. We give thanks for our speakers today and for the wisdom they bring to us. In your holy name we pray. Amen. It is now my delight to introduce Mary Kate Wold, the CEO and President of the Church Pension Group.
Hi, everybody. It's so great to have you here today. As some of you may know and may have participated in for the past 3.5 years or so, we've been hosting what we call a series of insights and ideas events around the country, from Minneapolis to Seattle to Houston to New York and Washington. And of course, now with the pandemic, we're unable to have those in-person events, but this is our third in a series of virtual insights and ideas events where we're able to bring experts to you to talk about the area of socially responsible investing, both positive impact investing as well as shareholder advocacy. And today we're talking about investing in underprivileged neighborhoods and how we address social inequality. 2020 was obviously a very difficult year for all of us. And in the midst of the COVID pandemic, issues of racial injustice and inequality came to a head yet again with the killing of George Floyd and so many other atrocities and senseless killings. There's been a loud collective call to action, and we all ask ourselves, what can we do? And of course, there are many different solutions needed, but one area is in the area of investing. And when we looked at our portfolio and thought about the people with whom we invest and the consultants we use, we thought, well, we're able to bring some experts to you, people who are working impactfully in this area of building neighborhoods and communities and diverse communities and addressing social inequality. And so I'm thrilled today to have a wonderful panel, not only thrilled, but just delighted to be bringing the people we're bringing to you today to talk about their work in this area. So first of all, let me introduce our panelists. The first is Daryl Carter. Daryl is the founder, chairman, and CEO of Avanath Capital Management. That's a California-based investment firm that acquires, renovates, and operates apartment properties with an emphasis on affordable and workforce communities. Since its formation in 2008, Avanath has acquired about $2.5 billion of properties with over 10,000 apartment units. Daryl himself has 39 years of experience in commercial real estate. We have invested with Daryl for a very long time. And in fact, you can see on our website a very moving video of one of the investments in our portfolio with Daryl. And I hope you'll take a look at that. Our second panelist today is Jasmine Richards. Jasmine comes to us from our consulting firm, Cambridge Associates, which she joined in 2018 as the head of diverse manager research, leading the firm's initiative to identify and research investment managers in areas where particularly people of color and women are in short supply. She has over 15 years of investment experience, and she is a very important advisor to us as we try to search out firms that champion diversity. And then Bobby Turner comes to us from Turner Impact Capital, where he is a principal and chief executive officer. Over the past 2 decades, Bobby's established himself as a pioneer in the area of social impact investing. Since its founding in 2014, Bobby has rapidly built one of the nation's largest social impact firms with over $3 billion of investments to address some of the country's most pervasive social issues, with real estate solutions. So in his years as a social impact innovator, Bobby has dedicated himself to providing sound financial returns for investors while fostering opportunities for communities in the funds where the fund invests. And then lastly, I bring to you Christopher Rowe, who is one of our own. Christopher is a managing director in our investments department. He's responsible for our socially responsible initiatives. He has over 30 years of investment experience working on the integration of social issues and investing, and has helped to lead diversity initiatives at a Fortune 100 company. So with no further ado, I'm going to jump into some questions for our panelists. And we hope that this will be interactive. We're going to leave some time for questions at the end, but feel free at the same time to put questions into the chat function. We'll be eager to hear from you. So Daryl, I'd like to start with you. Following the killing of George Floyd, you wrote a very inspiring piece entitled "Enough is Enough." And you drew on your own experience as a Black man in America, expressing anger, but also optimism. And can you talk to us a little bit about that as just to kind of set the stage for this discussion today?
Hello, everyone. And Mary Kate, thank you very much. And I always like to point out that, yeah, we've deployed $2.5 billion, but our Fund 1, which was in 2009, 2010, the church pension group was one of our first investors, and that's very special. And you always remember investors in Fund 1 because without, you know, because they're taking a chance on a company, and we appreciate that you did that. You know, certainly, you know, I grew up on the west side of Detroit, and many of the issues of social justice I've experienced directly, but more importantly, you know, one of the things that I learned that growing up, that the reason that my neighborhood deteriorated was because of a lack of investment. And, you know, that's always been the premise behind the, you know, companies that I built and investment strategy, that in fact, if you invest, you can have better outcomes, including in the social justice area. And so, you know, when the whole George Floyd thing happened, of course, it was very distressing to many. But one of the things that I think these, you know, situations like that, you know, hopefully brings out the best of all of us to try to focus on solutions. And I do think that one of the base core solutions, and I think, you know, Bobby has been instrumental in doing this as well as us, that if you invest in many of these communities, about 70% of our investments are in communities of color, they can have a positive impact on what happens in that neighborhood. And so that, you know, I was very angry, but one of the things that I kind of did an open letter to the apartment industry to say, hey, we need to invest more in some of these communities of color. 2, we need to focus in our own companies of being more diverse. And that really makes a difference in our business, in the apartment business, because in many communities of color, seeing a company that has people that look like them, we think is very, very aspirational to our residents. And so all those things, and trying to heighten the fact that more investment in communities and more diversity and creating opportunities for residents. For instance, we do after school programs and things like that, which help our residents in terms of, you know, I like to say our philosophy is not to only invest in brick and mortar, but we invest holistically in the communities and the people that we serve as residents.
So Daryl, that's one of the things that's really impressed me in following your investments is you're not only investing in kind of low income, affordable housing, but your projects bring a lot of services to a community and support for the people who live there. Could you give us a little more detail on that? I think it's just fascinating and inspiring.
Well, one of the things, you know, about half of our residents, and not to get into acronyms, but they qualify for Section 8 vouchers, meaning that they generally are making between $30,000 and $50,000 very often in very high income community, high rent areas like New York City, Los Angeles, and the like. And so one of the things, if you look at Section 8 as a housing subsidy for people of lower income, very often we have Section 8 residents that are 2-income families. It's just that they both work at Walmart and they live in LA. And the fact is, the school bus pulls up at 3 o'clock every day, and the parents don't get home till 7 o'clock at night or so. So those 4 hours are really very important as to what happens in that community. And we've learned that if we can create activities in a community, and we do after school programs at most of our communities where we have lots of kids, and we offer a variety of activities, including, drama, art, things like that, homework assistance, but also sports. I mean, we have, I probably, my salvation growing up on the west side of Detroit was my local basketball court where I lived. And so, it's interesting. A lot of apartment owners, they view and they say, well, we're not going to put basketball courts in because it attracts a certain element that, we don't necessarily want in our community. Well, when I was growing up in Detroit, gang members played basketball, but if they were playing basketball, that was something productive that they were doing rather than other things. And so, we've put, really nice basketball courts in. We've organized leagues and clinics, not only for young men, but also young ladies. And I have a 16-year-old daughter that volunteers at one of our communities who helps coach some of the young ladies in basketball. So, these are things that engagement of kids in our community when their parents are working is a very important attribute. And we find that there's a correlation between those activities and the number of police calls that come to that community.
That's great. And I have to just say you're very humble, Daryl, talking about your basketball, because you did let it slip before this call that you actually played basketball for the University of Michigan. So I just can't let that one go.
Go Blue.
So Bobby, let me turn to you. I mean, your investment thesis, I think, is in finding a mismatch between supply and demand in terms of community infrastructure. So talk to us a little bit about that. What's the dynamic and that underlies your investment approach?
Well, I'll start by saying that number one, I too, Daryl, played basketball. It was just for the Pikesville Junior High School team, where I developed a surety and a favoritism towards sitting on the bench, which I spent most of my time. Mary Kay, even before this pandemic, we have to take a look at where we sit as a society and recognize that this country has not lived up to its ideas. We have 43 million Americans who are living on food stamps. We have 1 in 3 high school students, only 1 in 3 that are proficient at grade level. 78% of full-time workers living paycheck to paycheck, and 1 in 4 families, something that Daryl and I are very attuned to, are spending upwards of 60% of their income on rent. And it's just not sustainable. Someone said to me recently, what's the greatest problem we face in this country? And I think that most people today think it's the disparity of wealth. That when 1% of a country or nation controls 90% of its wealth, that undermines the very fabric of society. And I actually disagreed with the individual. I didn't think that disparity of wealth was the problem. It is a problem, but I've always believed that poor people don't hate rich people. Poor people want to become rich people. What poor people do hate is when rich people create a society where they systemically subordinate poor people's opportunities to achieve, to have a clear path to upward mobility. And I think that's the biggest challenge we face. So at our firm, what we do is we take a holistic approach to that social safety net of how we're going to provide a clear and fair and almost level playing field for people to have a path to prosperity. And that comes in the areas of what I call the 3-legged stool of hope. We are investors in hope. We focus on education, which is critical to upward mobility. We focus on affordable workforce housing, and we focus on access to preventative and outcome-based preventative healthcare, recognizing the interdependency between the three. I've been in this space for a long time, and Daryl and I have been friendly competitors for a long time. And someone recently asked, are you afraid of competition, of people investing in your space? And I think Daryl and I agree is we're not afraid of competition. We're afraid that there's not competition. And the reality is these issues are so pressing, so daunting, that we need more people to recognize the need to allocate resources into these most pressing issues. I think that today more than ever, we recognize that making money and making change don't need to be exclusive. My first partnership back in 1998 was with Irvin Magic Johnson of the Lakers fame, when we raised a series of funds called the Canyon Johnson Urban Funds. To me, this was just smart investing. We recognized that there was huge mismatches between supply and demand of community serving retails in underserved communities. We recognized that there was a huge misperception of the opportunity, and we believed that we could make money and at the same time do good at the same time. We've been able over the last 25 years to prove out that business model, that doing good and doing well needn't be exclusive. Profits and purpose don't need to be segregated. And if you do it right, you can actually drive better risk-adjusted returns for investors, because we're just not speculating on demand. We're fulfilling existing demand that's going unmet.
Thank you very much for that. Actually, let me turn next to Christopher. Christopher, we've talked about investments in housing, and Bobby touched on investments that his firm is making in education and healthcare. But there are other areas too, and I thought you might have an example or two of investments that address the issues of climate change as it disproportionately affects different populations. Do you want to say a few words about that?
Yeah, thank you. So as investors that are looking to support church values in all we do, we have to proactively look for where our investment capital can make a difference. And so, of course, we are particularly proud of the investments that we made with both Daryl and Bobby and their respective funds, and hopefully the impact that we're collectively making with those investments. But then where else can we, as a church and as investors on behalf of the church, play a role in dealing with issues of societal inequity and social justice? And so one area, we have made a fair number of investments in the area of sustainability and solutions to climate change. And of course, climate change as a whole is a massive societal issue. But there are a number of people who have pointed out another issue within climate change is the issue of climate justice. That is, those who contribute least to climate change are the ones that are most impacted by it. And so not only should we deal with climate change for the face of climate change, but recognizing it is a meaningful social justice issue, that by addressing the enormous challenge of climate change, we are also hopefully having an impact on the most vulnerable on a global level. On a more local level, we've also made some investments that some of you may be familiar with. Also, there's a video related to this in off-grid solar units in emerging economies. And these off-grid solar units are placed in individual homes where they don't have reliable access to electricity. How does that matter? Well, so those homes generally are using kerosene instead of a cleaner energy, such as an individual solar unit. And clearly there's a climate issue there in terms of having an impact, but there's also a direct impact on the individuals that are living in those homes. Not only do they not use kerosene for their lighting, but then they're also not breathing in the fumes of that. They're able to work more productively so that it has an economic impact, and their children are being raised in safer homes. So hopefully, both on a macro level, that is dealing with climate justice issues by addressing climate change holistically, and some of the more direct investments we're making in local communities will have a difference.
Jasmine, I'm really excited to hear what you have to say on the kind of next aspect of this topic. And we've been talking about kind of what we invest money in, talking with Daryl and Bobby and Christopher. But also there's a whole issue of diversity in the asset management industry. And I think many of us who are familiar and immersed in the industry are frustrated by the lack of people of color, women in that industry. And this is very much a focus of your work. Can you talk to us about that? Describe these knotty issues and how you go about your work.
Sure, absolutely. And first of all, thank you for inviting me to speak. This is a fascinating panel. I think I'm getting as much as the audience just listening to everyone. So thank you for that. My team was created several years ago with the idea that you touched on, that women and people of color are massively underrepresented in the industry. And at Cambridge Associates, our whole reason for being, our goal every day is to create portfolios that deliver competitive returns, so our clients, such as the church pension group, can continue to do the good that they are doing in the world. We want to be able to fund the benevolent activities that you're doing, and to do that, we have to be investing with the best ideas out there. And looking at the demographics in the industry, with less than 2% of global assets, so not just in the US, but globally, invested with people of color and women, so well over 60% of the population, I would argue that there is a massive opportunity on the table for us to look in different networks, to find different ideas that we previously have not been investing in. And I would also take that further and say that the reason that we're doing that is yes, there obviously is the moral imperative, but I think it relates to what you've heard from Bobby and Daryl, is that when you have different lived experiences, you can see different investment opportunities. And we want all of those represented in the portfolio. The reason that Daryl can take a real estate fund and understand the opportunity to invest in low-income housing and the actual way that returns can be generated by delivering these services is because he is able to see that opportunity through his lived experience. And we would argue that everybody should be represented at the table. You don't just want one view. And so I see the goal of my team is going out and finding those undiscovered opportunities, people that can see different investment that we can put in the portfolio. And so I'm excited about the work that we're doing. I think it also means that I get to have fun conversations like this. But with the demographics and the way that they are changing, we think that the time is now, and it's getting to an area where it's critically important. In the US, by 2045, over half of the population, I hesitate to use the word minority anymore, because that is not what the demographics are. If you look at people of color at the end of this census, college school age children will be majority underrepresented communities. And so we think that if you want to continue to invest with the best, we have to be looking in different places. And that hopefully that also means that the industry overall has to change. What you're seeing is in 2019, we started a survey of all of our managers where we started asking not only the ownership of the firm. So yes, firms can be diversely owned, but we wanted more information than that. We wanted to understand the composition of the management team, the composition of the investment team, who is really making decisions at the end of the day. And I just happened to be going through some of that data last night. And obviously the industry is where it is. We have the data to show what we all intuitively know, that the industry is not diverse. But what you are seeing, because we also want to understand not only the temperature of the current water, but the temperature of the water that's coming into the bathtub, so that we can predict that change. And I think that you're starting to see more awareness of the changes that need to be made. What I would push on is that it's great to build the pipeline and have those junior people come into the industry, but I think we also have to focus on the leadership of firms. And so some of the changes and emphases that you've seen over this past year, I think are also welcome.
Hey, Mary Kay, can I add that I
absolutely,
think
Bobby,
that I think Daryl would agree with me wholeheartedly, that as investment managers, as fiduciaries to the church's capital, our jobs are to identify, quantify, and mitigate risks so that we drive risk-adjusted returns for your portfolio. Diversity is a competitive advantage, is what it really boils down to. And those that are not employing diversity as a risk filter to identify, quantify, and mitigate risks are doing a disservice as an investment manager. At our firm, we're 260 employees, of which we are 90% diverse meaning non-white men. We are 52% women, meaning non-men. And where we lack diversity is in our fanaticism, where we are 100% fanatical of using market forces to really create durable, scalable, and yes, profitable solutions to some of our most pressing issues. But diversity is not necessarily just gender. It's not necessarily just race or religion or sexual orientation. It's also vocational diversity as well. Again, we're taking a holistic approach to enriching communities with hope and making money while we're doing it. But in our education fund, by way of example, how would we be able to identify, quantify, and mitigate the risks of public education unless we had public educators on our staff? So our team of 260 people consists of both evolved capitalists, and these are capitalists who have recognized that using business as a force for good doesn't come at a sacrifice in yield. In fact, if you do it well, you'll drive better risk-adjusted returns. But we also have enlightened philanthropists, and these are people who have come from the mission-driven side of the world, who have been frustrated with the inability to create durable, scalable solutions that stick through traditional not-for-profit avenues or distributions. So on our school team, we have former public school superintendents. In our healthcare team, we have former primary care physicians. In our housing team, we have people that grew up in public housing. And we recognize that the interdependency of this knowledge enables us to be a better investor, driving better risk-adjusted returns. I will tell you, and Daryl will attest, in our housing fund, our job, and I think we all agree, is that, listen, we have a housing crisis and everyone suffers when we don't have affordable housing in close proximity to jobs. Families suffer, the environment suffers, productivity suffers. 1 in 4 renters, nearly 14 million families in this country, are spending upwards of 60% of their income on rent at the expense of food security, health security, and retirement security. It's just not sustainable. Part of the challenge is the demand is large, it's growing, and the problem is there's no new supply of affordable workforce housing, because every time existing, first of all, it doesn't make economic sense given the cost of what it takes to build new properties and where wages are. So
Bobby, I want to hold 2 thoughts there. One, you raised the reference to philanthropy, and 2, the economics of affordable housing. So I want to return to those 2 topics. But before we leave the topic of diversity of asset managers, and for those of you who may not have caught on, when I talk about diversity in asset managers, I'm talking about who owns the firms like Daryl's and Bobby's, and who are their employees? Who are their employee owners and partners? Are they, people of diversity or not? And I have to say, in looking at investment after investment, it's very hard. It's been very hard to find firms that have significant diversity in their investor and ownership ranks. So that's what we're talking about here. And so, Daryl, I want to go to you. What are you? How do you think about diversity within your firm in terms of your partners and employees and such, and what role does that play in your success?
Well, I think it plays a big success, and we are very, very diverse as a company. And one of the things that people talk about it, but one of the things I like to think about with this is the how it really makes a difference from a actual business. I will very often go out and look at a property, and and I'm like, wow, this is nice. And but hey, let's face it, I'm 6'8" and I grew up on the west side of Detroit. There are very few places I find that are unsafe. I'm a big guy and I grew up in a bad neighborhood. But so I send a young lady, very, different ethnic group, who go to the same neighborhood, and they'll say, I wouldn't live there. And that's good to know. I mean, and so we all have biases, and it doesn't matter what your ethnicity is. I have biases because I think most places are safe. And, so I have to, some of my particularly female staff, because, in the housing business, about 60% of the decisions for housing decisions are made by females. And so whether they're single or married or whatever, they make that decision. So, I've just learned to get rid of my biases and try to expand that. But getting to the point of how do we create more, or how do we You know, I think that, you know, certainly there are some structural issues that have existed. You know, I started my first company in 1992. And one of the questions was, it easier then or easier now? And in many respects, it's harder now because some structural changes. You know, if you look at the investment asset management business, there has been so much consolidations and so many of the, if you look at assets worldwide, 90% go to very large multinational, and you know, we all know who they are, JP Morgan, Blackstone, BlackRock, you know, and because at the end of the day, that's where, you know, this consolidation has happened in financial services. And maybe 10% go to niche firms that have some unique strategies that provide alpha. One of the challenges is particularly, and I think Jasmine's company is an outlier here as a consultant, because certainly they have been instrumental in raising awareness of our, you know, to investors of what we do, and have actually been key in bringing in $70 to $80 million of capital in our latest fund, because they've taken the time to get to know us, where really in mainstream, if you look at the state pension funds and some of the big, you know, and then the other many consulting firms, let's just say no one gets fired allocating money to JP Morgan. It just, they won't. I mean, because everybody else does it. So one of the things is trying to break that cycle where, you know, people are, you know, are incented to seek out unique opportunities and diverse managers, which the way the system is, where the big has gotten bigger, there is just, again, there is a focus of not trying to keep it safe, if you will. And that's the perception.
And well, I'm going to jump, even though I'm not a panelist, I'm going to jump in quickly and say that's where we found opportunity at CPG to become anchor investors in smaller firms, where we put in the elbow grease to make sure that, you know, we get the appropriate risk-adjusted return, but we're willing to make that leap of faith and then pull other investors in with us. So that what you're saying really resonates.
You were my fund one investor.
Exactly, good example, and it paid off. But Jasmine, let me go back to you. I mean, we're kind of singing to the choir here, because I think we all agree that not only is there a moral imperative to drive diversity in this industry, but it actually pays off. And but how intractable is this problem? Because are we seeing significant progress here? If not, why? And what do you think are some of the solutions to, you know, accelerate the progress?
So I think we have absolutely seen a shift in the last year. And if you asked me in April what I thought last year was going to be like, quite honestly, I thought I was going to be able to get some research papers done, that I was going to do lots of deep work, because when the volatility of markets pick up, usually I think diversity is the last thing people are focusing on. And so, but the year couldn't have been more different. And I think that it's been great, the level to which asset owners have focused not only in doing kind of the performative measures and making donations and putting up, you know, different statements, but we have really spent the last year digging in deep with asset owners on evolving their investment policy statements, expanding their networks of managers that they're sourcing from, really thinking around doing the deep work of how to implement measures that will last past this moment. And I think that definitely is good. The catch is, okay, well, you have the intention now, how do you actually do it? And I think that's where the real work comes in, because it touches on some of what Daryl was just mentioning, where I think it's more than going out and finding a different list of opportunities. The real work is changing the lens through which you're evaluating those opportunities. You can't just take different meetings. It's rather than saying, I only want to invest with a team that has worked together for the last 10 years. It's understanding that less than 2% of general partners in private equity are women or people of color. What are the odds, right? Like that some of them have worked together, right? Like that just isn't really something that's going to lead to a wide universe. What I think is key is then taking that metric and doing some reflection on what you were trying to get to with that measure. So I think what you're really trying to measure is this a team that is going to stay together for the foreseeable future, particularly if I'm locking up capital for the next 10, 12 years, which is a reasonable thing to measure. I would argue that there's other ways to get to that answer. If the team has personal relationships, if they've come together around a solid idea, I can contact other people who've interacted with this team. I would tell you that one of the best investments that I feel like I've made last year was a team that they hadn't worked together. But when you do reference checks, you find out that they're probably one of the best functioning teams that I've seen in my career. And so I think you have to get away from those easy tricks or rules that you typically are using, because otherwise, right, like it's the definition of insanity where you're doing the same thing and expecting a different result.
Excellent. Well said. Thank you.
I'd like to try and pull in some of the audience questions just to keep the audience engaged and encourage people from the audience to continue to ask questions. I mean, and Jasmine, on your notion of the bathtub and filling up the bathtub, a big question is the talent pipeline, and how do we encourage the talent pipeline into our industry? And so I'm curious from your perspective, and then also Daryl and Bobby, in terms of recruiting, what can we do more in the recruiting area? And the specific question from the audience is, what is being done in terms of engaging historically Black universities?
That's so interesting, because I was thinking as you were talking, Jasmine, too, are young people of color and women discouraged to even think about going into this industry, and therefore giving themselves, investing in the background that they need to be competitive, getting their MBAs or CFAs or whatever. So yes, please do respond to that question.
I would say that one of the largest areas of growth that I am seeing, quite honestly, in the fund manager landscape is in the venture world. So I would say that this still absolutely is an area of interest for women and people of color. I think the challenges come when you're trying to figure out how to access it, particularly given that asset management is an industry that was built on an apprenticeship model. I think that the key to really changing the demographics is, yes, building out the junior ranks and the pipeline, but also focusing on that leadership, because I think visibility matters, right? Like you need to be able to see yourself at a firm to feel welcome, to understand that you're going to be supportive. And so I think what Bobby touched on earlier really goes to it. It's, if I'm running a healthcare VC firm, yes, I need someone that maybe did healthcare banking for 10, 20 years, but you know what? I also probably need an operator looking for a physician or someone who has come from industry. I think that's also a creative way of growing the senior ranks, which are as important as in growing the pipeline.
Excellent, thank you. So we have a few minutes left before we turn it completely over to questions. And Bobby, you raised two issues, as at least in my mind as you were talking, and that I think I want to touch on for a few minutes. One is the sheer economics of investing in affordable housing. And the second is the role of philanthropy versus investment capital. And so if we could just touch briefly, maybe Bobby first and Daryl, to how do you actually make money on affordable housing? Where you're trying to make housing kind of affordable for residents, how do investors like the Church Pension Fund, who have to make money to pay pensions to the people who are relying on us, how does that work?
Let's recognize that both impact investing and philanthropy are critical to addressing some of our most daunting challenges. Because the reality is not every issue can be treated with a market-driven solution. We operate 115 schools serving 57,000 kids in underserved, underperforming school districts. We figured out a viable, innovative model to make money by scaling best-in-class educators and their operations. Notwithstanding, teenage pregnancy is a critical problem that we have in a lot of our schools. I have yet to find out how to make money off of teenage pregnancy. Notwithstanding, it's an essential issue that we have to address, and therefore that's where philanthropy comes in. Making money and making change needn't be exclusive, as we said. When we think about affordable housing, and what we want to do is we want to make money, but we don't want to necessarily make money by driving revenues or increasing rents on the very consumers who have not seen wage inflation over the last 25 years. So we have a very, very innovative model. And I think Daryl and I share a lot of common themes as to how we can drive profitability. As most investors, there's two ways to drive profits. You can increase revenues, which we don't want to do, or you can reduce expenses. What I've learned from 30 years investing in urban communities is the biggest expense of owning and operating workforce housing is turnover, because no one works 2 jobs a day, comes home to a less than quality apartment building in a less than quality neighborhood and screams, "I'm so proud to live here." Therefore, it's a very transient community. The pride in rentership is very low. So our business model is based on the fact that if you can drive a pride in rentership, if you can increase the lease duration, you can increase profitability, not by increasing rents, but rather by driving down expenses, the biggest expense being turnover. And what we realize is the way we approach that is rather than buying a property and improving it with new bathrooms and kitchens, which candidly, as everyone's mentioned, 60% of housing decisions are made by women. The same number or percentage even higher are focused on education and healthcare. So what we do is we drive our tenant satisfaction by enriching our communities rather than improving them. We enrich them by taking a subset of our apartments and subsidizing them for essential service providers, teachers, policemen, and healthcare workers, oftentimes coming from our schools that we've built or our healthcare clinics. And those subsidized renters then provide, in turn, they provide essential services in the form of mentoring programs, health fairs, community watch programs. And what we've been able to prove over the last decades is that when you enrich a community, when you create a pride in rentership, you can drive economic returns. And our math is real simple. Over the last 5 years, we've enriched our communities with over 90,000 program participant hours. That has driven our tenant satisfaction from below 30% today. Our portfolio sits at 95% tenant satisfaction. Now that's great, but it's not great if it doesn't drive profitability for us. So we then look and is there a corresponding increase in profitability? And the answer is yes. Because we have driven tenant satisfaction, what's happened is our lease duration, the average length of a tenant staying in our property, has grown by nearly 35%. From under 2 years, now they're staying over 3 years, which means we've driven down our turnover and vacancy costs. When a consumer has pride in rentership, they treat the properties better, which dramatically reduces your capital improvement costs and deferred maintenance. And more importantly, when you create a safe environment, we have law enforcement agents that live in our property, incidences fall. In many cases, they fall by over 50% in 1 year, which means we're driving down insurance costs. So by driving down economic loss, we can actually increase net operating income by upwards of 6 or 7% without ever increasing the rent on the very consumer who has seen no wage inflation. That's social impact investing, where you can drive profits by focusing on purpose.
I will just add this. I mean, Bobby, you took everything. I agree, and we do everything that you say. And but it's important to just highlight that conventional wisdom in the apartments business is that you need to drive rent increases, which then creates 40 to 50% turnover in residents a year. And the same thing, I mean, our average duration is 5.2 years. So our turnover is less than 20% a year. But the one thing that we have learned is how do you make a property safer is for people to know their neighbors. So if they stay longer, it also becomes safer. So these are metrics that, translate to occupancy and, the same thing, we have much lower turnover costs. So, sometimes people, and with 2% rent growth, we generate great returns. And that is modest enough for most residents to pay. So I think that, there's a lot of conventional thinking in the apartment business of creating value that I think is a bit antiquated. And, it just touches on one thing that I noticed there are a number of questions about gentrification and the concern of investing in communities. And my view is that what we do hopefully will make a community nicer. And when you look at the whole concept of gentrification, the bad part of it is displacement. But to me, adding people of higher incomes to a community is a positive thing because it becomes aspirational. It's just trying to displace people, which is the negative.
Thank you. Well, I thought the point that you just made was so interesting about changing the metrics for success, because the metrics you're suggesting, Daryl and Bobby, you were suggesting in terms of people knowing one another, and that they're kind of soft metrics, but they drive financial returns while at the same time being indicators of well-being of your communities that you're building. So it's a fascinating way to look at it. And I don't know if either of you have written papers on that, or you, Jasmine, but that sounds like a fascinating topic for a white paper. So thank you.
One other interesting observation with respect to affordable housing and the attractiveness of that as an investment, both for the church pension fund, where we're looking to make a positive social difference and earn a return. Obviously, the 2020 markets were volatile. Clearly, real estate was impacted as an asset class. But I think you can share some observations around really how did your investment portfolio hold up vis-a-vis other real estate investments in 2020?
Well, you know, one thing I'll say is what Bobby touched on earlier is really important. I mean, number one, that January 1st, 2020, we had an affordability crisis in this country. And today we have one. Nothing has changed. In fact, more people through COVID have become more the need for affordable housing. You know, our performance during COVID, I mean, we have maintained our occupancies actually went up about 100 basis points. But it's important to understand, and Bobby touched on it, you know, what he and I do, and you could take 3 or 4 of the other people who are in our space that do a lot of in the affordable housing. We're just a tiny blip of what is needed out there in the space that we're investing in. And so one of the things that I think is important for people to realize that, you know, I mean, I rarely compete with Bobby. I mean, and I rarely compete with other people who are large operators because the universe is of need is so great. The one thing that I never lose sleep over at night is where I'm going to get my next renter, because most of our communities have waiting lists.
Yeah, Gary, I will support that and echo it. And I tell people over and over again that while it's too soon to determine the magnitude of disruption caused by this pandemic, it's clear, I think, to all of us that, number one, it's going to hit and has hit our minority communities much harder than others. And it's highlighted just how fragile our most vulnerable populations are to economic, political, and other unforeseen emergencies. It's also going to exacerbate the government's inability to create lasting solutions because there's just going to be less money to spend at the government level on the social safety net of education, healthcare, and affordable housing. On the other hand, and to confirm what Daryl's saying, is this pandemic is actually confirming the thesis that the underlying demand for community-serving infrastructure is huge, growing, and moreover, it's less correlated to the broader indices and economic conditions. Think about what's happened to the demand for retail shopping centers or office buildings or hospitality. And think about what happened to the demand for affordable housing. We're collecting in the high 90%. Think about what's happened to the demand for community-serving healthcare or for education. Simply put, this pandemic has actually validated our thesis of the past 20 years that investments in densely populated, ethnically diverse communities is just smart investing that drives superior risk-adjusted and defensive diversification for portfolios.
So, Bobby, we've found the area of affordable housing to be a successful and really gratifying area to be investing in for a long time. But with this need that's pre-existed and now only intensified, usually investors fill in to fill a gap. Why are we still seeing such a great need? Why don't we see more firms like yours, Daryl, and yours, Bobby, rushing in to fulfill that need?
I think it's a misperception of risk, and secondly, it requires unique skills to identify, quantify, and mitigate the risk. I mean, we talked about diversity before, and everyone talked about the challenge, but let's not ignore the elephant in the room, and that there's still a deep amount of not only misperception, but prejudice in the institutional allocation of capital. It's just a fact. I remember 25 years ago when Magic Johnson and I went out to raise our first fund, and Daryl was right in the trenches with us. I bet Magic always told me there'd be two words that would define this opportunity: arrogance and distrust. Arrogance on behalf of capital, who assumes because we are smart and have capital, we know how to solve the problems of social injustice, and distrust from communities who suffer the injustices of social determination, who assume capital is there just to make money. And I remember betting Magic when we raised our first fund that it would only take us 6 months to raise it because the fundamentals were so strong. And he bet me it would take 2 years because the prejudice was so strong. And Mary Kay, had you bet on both of us, you would have been right, because it took us 2 years and 6 months to raise that first fund. And I'll tell you something, 20 years later, a lot hasn't changed. It really hasn't, but the opportunity has only gotten greater. So it's for those forward-thinking investors like the Church Pension Fund and managers like Daryl and others like us who recognize that doing good and doing well, if done correctly, is just smart investing. And it creates a real great opportunity to make great risk-adjusted returns and, by the way, enrich in the future of a stable and sustainable society.
So what you just said, I think, leads me back to Jasmine, because you're saying that, you know, some of the reason that there's still such a huge gap is that people don't understand. There's a misunderstanding of the space and the opportunities and such. And Jasmine, I think what you're doing and trying to drive diversity within management firms and management and ownership of asset management firms is a way to move the needle here too.
Yeah, I think that that's really at the core of the reason that we're seeking out different investors and seeking out different networks. One of the is because everyone is entitled to different opinions, right? Like that's why we have markets, right? Like if we all thought the same, right? Like we wouldn't have a market to invest in. What we're saying is that there needs to be additional voices. There are different voices that are missing from this conversation. Piece of our research process is to not only speak with Daryl and Bobby and their teams, but we also do references, and particularly on the private side, that means we'll usually call founders that investors have invested in. And I can say that these misperceptions certainly aren't limited to affordable housing. I think they go throughout the market. And part of the reason that we will invest with other diverse founders is because diverse investors is because they also will, therefore it will trickle down also to diverse founders. I was speaking recently with an entrepreneur in a venture capital portfolio, and it was a team of two Black men who created software that is used for barbershops. And it helps them make appointments, do transactions, and actually has grown significantly in this environment, really, where we all are quickly moving to a cashless society, and you're trying to limit the number of people that may be in a barbershop at any given time. The reason they had such trouble fundraising was because they would go to traditional investors in Silicon Valley, and anytime they met with someone, the people across the table very often were not a team of other Black men, and they would see them, and while they were telling them that this software was for barbershops in general, what those investors saw was that this software was for Black barbershops. That is not what they were saying, but that is what people were hearing just because of who they were. And where this then trickles into portfolios is that those investors across the table were sizing the market wrong, right? Like, which leads to a different valuation of those companies, and therefore they weren't doing the deal. And so who they ultimately ended up having lead that deal was another team of that we were investing in that were Black men themselves, and therefore they could see the market differently. They could understand how the product would be used differently. And to me, that's what we're getting at. Daryl and Bobby, because of the reason there aren't more people doing affordable housing is because just like Daryl can understand, I might go to this community and see it one way, but check himself and understand the biases in that view. Other people might not do the same thing. And so they will go to that community and just think that this is a bad investment. We want other people that can see different opportunities in those investments. And that's, I think, what we're really getting at by trying to find diverse investors.
Well,
I think Daryl and I are wondering what a barber shop is.
Yeah. By the way, I've seen that happen. It's pretty good. But, one thing, again, Mary Kay, to your question about so much of it is perceptions. We had an investor that was going to go see one of our properties and literally called me in a panic to say, if I go there today, am I going to get shot? And my response was, well, I don't know what your personal situation, or if you're have, ex-spouse issues or whatever, but is it become at my property at 10 o'clock, and this was in Loudoun County, Virginia, which is a very affluent area, but those are the perceptions, and that's the challenge. And sometimes if you don't have someone who grew up in a neighborhood like that, or at least has a perception, the other thing I would just like to give Bobby just great marks for in terms of diversity, something that we certainly wouldn't do and that is partner with anybody from Michigan State University. And I commend you on being that open as a University of Michigan person. But anyway.
Oh, that's funny. One of the challenges, Mary Kay, and I know Jasmine knows this, is, listen, most institutional investors are risk adverse, and they're not paid to take unnecessary risks. And one of the challenges, and this is Daryl's and my responsibility, is to train the next generation of minority managers. Because for a manager to be able to qualify for institutional capital, they have to have a proven track record. Again, you go through the layers of consultants and advisors, and the first thing they're going to look for before they're going to recommend an investor to invest in a manager is, what is the track record? Do they have a proven track record of driving returns? And again, this is the challenge, is there's a lack of diversity within existing managers. And one of the commitments we have, and I know Daryl has, is to train the next generations. I'm never upset when someone leaves me to start a competitor, because again, I'm not afraid of competition. I'm afraid that there's just not enough competition. And that really is a challenge that we all have to focus on, is empowering and enabling the next generation of minority managers the opportunity to create that track record from which they can build upon to raise institutional capital going forward.
And that's
great.
That's part of
Jasmine, yeah, I was going to ask you to respond, because that's your wheelhouse too.
Yeah, I think that's part of the structural issues that we're thinking through, right? Like, all of this is one tiny piece of a much larger systemic issue. And I think what we're trying to think through is, often what you've seen historically is that fund managers will build that track record by having some friends and family money, right? So it's great if Daryl can have that in that fund one investments from the church pension group, but traditionally you don't see that from institutional investors. Really, traditionally where people have started is, I'll go to my parents, right? Like, maybe they'll give me some money, maybe their friends will, maybe I've worked at a hedge fund for 10 years and I've had some great windfalls, and I have my own money that I can invest. But if we think through the historical inequities within asset management, but I think the world as a whole, it is very reasonable that and people from underrepresented backgrounds do not have, we did a study several years ago, and to start probably a public equity shop, you probably need, 5 to 10 years and at least like $3 million, right? Like, and everyone doesn't necessarily have access to that. If you're trying to build a private equity track record and the investment period is 4 or 5 years, that means that not only are you sustaining yourself over that time, right, like, but you're also not taking income. It is perfectly reasonable that someone can be a good investor and not have those resources. Those are two different situations. And so what we're trying to think through at Cambridge is how can we get the flywheel going? One of the is can we find clients that we're working with that are willing to take those earlier bets? Can we find foundations that have programmatic related investments, often where maybe the risk profile is different, and we can do the research, we can think of creative ways to get comfortable with that strategy and that investor that maybe aren't the traditional ways. But we have to think about how we can get fund managers early in their life cycle access to that capital to build their track record.
Jasmine, how do we incentivize, candidly, people like me to hire and provide opportunities. Because someone recently asked me, what's my greatest fear in life? And I think the answer is being discovered for the fraud that I am. What did I do to deserve the success I've had in my life? I'm smart, I work hard, but there are millions of people who are as smart as I am. There are billions of people who have worked harder than I have, and none of them would have had the opportunity and success that I've had. And my success, a lot of it is just based on luck. And because I recognize and have the humility to recognize that luck played a role, I feel this burning desire to pay my good luck forward. And that's why one of the reasons, other than it being just smart to have a diverse team, but what I think is the vast majority of people in my position who are running large private equity firms don't actually believe that luck has played a role in their success. They actually believe that they're entitled to the success. And with that arrogance comes a perpetuation of the systemic foreclosure or exclusion of minorities in the institutional investment management business. And I'm not sure how you get arrogance to incorporate or evolve into to humility or be committed to it. But at our firm, I think all of us get up every day and say, we are just so fortunate, and our job is to pay our good luck forward.
You know, I would also add one other point, okay. Mary Kate, that
go ahead, Daryl.
Post-financial crisis, institutional compliance is from when I started my first company in 1991, 1992, from that era, the institutional compliance is probably a 2 or 3x more in terms of people. Even though we have greater technology, my people account for my back room is more per dollar of AUM than it was 20 years ago. And that favors the big firms, and so one of the things is we have to figure, how do we create structures that provide safety for institutional investors, but still allows a smaller firm to compete on a backroom and compliance aspect. And so that's
right.
something.
And that highlights the point that Jasmine was making, that there is just this financial hurdle that you have to overcome to get a start. And not everybody has access to that initial capital to be able to kickstart a firm or an opportunity. So yeah. I think, please go ahead, Jasmine.
I think the way that we start shifting is first by mandating the data. And we started in 2019, and thankfully David Swenson also published an article that a lot of people read that demanded different data. So first is having those conversations. I will tell you that when we sent out those surveys, I was pleasantly surprised that even though fund managers weren't where they were, most were interested in figuring out how to get there. I think it's a touchy situation, but I believe that more people are trying to do the right thing than not. And so hopefully that pushes. But I think also, honestly, I want to start sharing success stories, right? Like I want your fund and Daryl's fund for us to be able to say, this is what they did, and it delivered those returns that we were looking for, and others are trying to figure out how to get there. What I want is for clients to also start sharing those success stories with their peers. We obviously advise clients and can put ideas, but I also know that there is part of within the industry, socialization of ideas still matter. And so I want for everyone to feel the same way that they feel about you can't get fired for investing with JP Morgan or BlackRock, for people to say, oh, wait, they did great, but these fund managers over here did even better. And suddenly I look at maybe those returns in a different light. And so I think we really need to start highlighting those investment opportunities more.
But Jasmine, we need people like David Swenson to not just talk the talk. He needs to walk the walk, because Yale University Endowment is not an investor in workforce housing or affordable housing. They do not believe it meets the risk profile of their endowment.
At least you got a meeting with them.
Well, we do. So,
We do.
So, well, we've been there for a long time successfully, and we're proud of it. But you know, this is such a great conversation. I have at least 10 or 12 additional questions I'd like to ask, but I promised to leave time for the audience, and I've already cut into that time because I just can't resist asking some of the questions I still have. But I'm gonna open it up now for questions from the audience, and I know there are a lot of them for you all. So
there are a
let's
number.
take some audience questions.
And one sort of series of questions is both a sort of, I'll take it as an opportunity for an advertisement and then a follow-on question. A number of individuals are asking sort of, how do we as an individual parish or an individual investor participate in socially responsible investing broadly and also in these particular investments. So the advertisement is in February 18th is our next Insights and Ideas event, where we are going to feature Faithful Investing, which is a book written by a church publishing author that speaks to how do individuals and individual parishes approach the question of socially responsible in February. But then back to this panel, I mean, there's enormous enthusiasm for the investing in underserved communities that Daryl and Bobby do. Are your funds available to individual investors? If not, how do people that are clearly moved by what you've said today participate in solutions into these communities?
Daryl and I are looking at each other saying, you take it. No, you take it, Bobby. You take it, Bobby.
But if you have a pension, you already are investing.
Yeah. I think one of the, yes. So at the institutional level, ESG and SRI investing, there's a couple of places that you can be impactful. You can go to the easiest, which is to invest in mutual funds that are using social impact as risk filters. To invest in funds like Daryl's and or mine, because of the limited nature and the private equity nature, it's very difficult for smaller investors to invest with us. So by investing through your pension fund, that's super. I think one of my goals, and I know one of Daryl's goals is to democratize the opportunity to invest in funds like us through long-term permanent capital sources, like taking our companies public on stock markets or things of that sort. But at this point, funds like Daryl's and fund like mine are really limited to larger institutional capital and investors.
But Daryl, you make a good point, because the Episcopal clergy who are on this call and lay employees who are part of our defined benefit plan are invested in each of your firms indirectly through our pool of assets. And to the point you were making, Bobby, also for those who are in our defined contribution plans, again, clergy and lay employees of the church, there is an SRI option within the menu of options in that plan to look to as well. Other questions, Christopher?
So as we are moving toward a new administration, there were questions around sort of how is this new administration going to impact the affordable housing space, and what do you see on the horizon in the next years to come? Well,
one of the things, and I've been in touch with some of the people on the transition team regarding housing. One of the goals for that the administration, the new administration has, is to do 15 million new Section 8 housing vouchers that support low and moderate income families. And that would be a huge positive impact, on the housing crisis in this country, but also beneficial to Bobby's firm and my firm as a source of payment for residents. But I view it as positive in terms of that initiative, and certainly, I think that there's already a greater focus on diversity, which has got to help everybody.
Yeah, I would agree with that. I think that I'm more hopeful today than I was a year ago. Notwithstanding, I'm also a realist, recognizing that the ability of the government to support and invest in the underlying social safety net in areas like housing, education, and healthcare have been handicapped by this pandemic. The amount of money that's been spent, the amount of debt that we've assumed will cause an additional burden and challenge on state and local governments to be able to address these issues. And I always go back to, if you want to treat an issue, then the government and philanthropy are fine. If you want to cure it, you have to harness market forces like funds like Daryl has or we have to create durable, scalable, and sustainable change. So I'm not going to wait for the government to, our reliance upon the government has actually handicapped our outcomes in a number of verticals. So while I'm optimistic, I'm also a believer that hope is not a strategy.
So one question that came in relates to sort of the opportunities for individuals that are residents within your communities to build equity or build wealth. So, I mean, rent is one thing, but home ownership is another. How do we think about the transition from renting to owning and the value of being an equity owner as opposed to a renter?
You know, we've been involved in one thing. In our communities, people are paying 30% of their income. So it is interesting in some of the lower cost markets, we've actually had people that save money because they are only paying 30% of their income for rent to then save money and buy a home. We actually are in partnership with the Florida Housing Finance Agency and this is a fabulous program because we basically allocate 5% of their rent to an escrow account. If they pay on time, and when they move out, they get that money as down payment assistance. So what we have learned, and that is a program that I wish we could do everywhere in the country for one reason. One is that in those instances, our average resident stay is about 11 years. And if we had turned that, and they leave with about 11 or 12 or between $11,000 and $15,000 of equity. If that apartment had turned over every 3 years, I would have spent far more than that, than having that resident stay at that time. And then they're able, and Florida Housing and Finance Agency provides them the mortgage, and they also do credit counseling over that period of time, and they leave and they buy homes. And so I think that program, I would love to replicate it because it really requires a little bit of, to me, government assistance where someone or a large financial institution, I've proposed this to a number of banks, some of our banks that are investors, that, you know, that this would be a really innovative program. But, you know, it is a, you know, I'd love to see, particularly in African-American, Latino communities where the home ownership rates are much lower, to be able to transition to get more to be buyers. And I think it's a key part of the long-term equity in this country where, you know, if you know, where we can get the home ownership rate higher in those communities, I think it would be a positive.
Terrific. I think we have time for perhaps one question, which I'll turn over to Jasmine, which is sort of obviously with Bobby and Daryl and their expertise, we focused a lot of our attention on housing and investing into underserved communities, but the whole sphere of impact investing, and I'll ask you to get a little bit sort of put your Cambridge broad hat on. I know Cambridge, I mean, has helped us into sort of thinking about impact investing and where can we put our capital to work for positive social impact beyond the two investments that we've made here. Can you talk to sort of the universe of impact investments and the kinds of ways investors can use their capital to make a positive difference?
And I like the way that you put it, because we think about it the same way, where really what you're focusing on is investing in positive impact. We would say that all in investing is you're having impact either way. It's which direction do you want to go, and once you think through that lens, then the world of impact investing, I think, becomes very broad. We touched on climate justice earlier, which was a big deep dive that we did last year. And we're starting to find strategies in that area of really figuring out that intersection of social justice and environmental issues. We also will think about natural resources like water, and you can focus on that area. I would say that across what we're seeing across our clients is that within Europe, they're making, in some ways, progressing a little bit faster than we are here in the United States. And maybe that's, partially due to recent regulations where we decided that you cannot have ESG as a factor within pensions, and maybe that's changing soon, hopefully. But we think of the world as very broad, focusing on the environmental needs, energy, agriculture, and as well as the social issues as well. But there also are tons of ways where that intersects. When we did a deep dive last year on education as a fundamental right, particularly in this recent environment, and figuring out how that changes and really how you make that access accessible across different areas of the population. Does that intersect then with infrastructure and telecom? And we invested in a fund that was focusing on towers, but specifically in areas where the internet was less accessible. We've also done a deep dive on healthcare, which we would argue is also impactful in making sure that there's democratization there. And how does that intersect with gender and race as well? And so we view it as through a very broad lens, but the idea is to find investments where we really get that additional alignment. We're absolutely not sacrificing return, but for our clients, we want to be able to also add the additional benefit of having alignment with their specific mission and goals as well. And so we're looking for opportunities really across the board. But what we've been encouraged by is I think this is an area that is absolutely growing. We're understanding that the weather is changing, and how does that impact how we're thinking about our real estate investments. And so really it's just an underlying issue that we look at across all the strategies that we're investing in at this point.
Wonderfully said, thank you. And we're now over our time. And Bobby said, I think hope is not a strategy, but nevertheless, I'm going to ask for like a 5-second rapid fire from each of you. A couple of words of hope for 2021. Where do you see hope in 2021? And then I'm going to thank you all and say goodbye to everybody. Bobby, we'll start with you.
I see hope in conversations like this. This is incredibly encouraging. And again, Mary Kate, under your leadership and under the Church Pension Fund, you're setting an amazing example on how to do good and do well at the same time. Impact investing has never been more important to the state of affairs in our society, and never been more rewarding as an investor. So I'm grateful to you and all of your colleagues for having the wisdom, the courage, and the ability to invest with folks like me and Daryl.
Well, thank you for that. That was not the intent of my request, but we appreciate the compliment very much. Jasmine.
I find hope in the empathy that I think was built over the last year. Even though we've been distant, I think through technology, I know what more of my colleagues' houses look like than I ever would imagine, but we've also been able to see through some of the social unrest, the way that the world doesn't impact us all the same, and have had time to really think about that deeply. And so that's where I'm finding hope at this point.
Thank you. Daryl?
Well, I'm an optimist. You have to be an optimist if you're in our business. And I view that, even the destruction that happened last week, which was just horrific, that, people, many of these things shock us to doing the right thing. I mean, so unfortunately, a lot of good very often arises out of things that are bad and ugly, like the George Floyd thing and the pandemic and the like. And my hope is that many of these things will force us to examine issues like healthcare, housing, and equality in a manner that is more than discussion and real action.
Thank you. And Christopher?
I find hope in the inspiration that has been provided by all of my fellow panelists. I really appreciate all that you bring to the Church Pension Fund, and indeed to the problems that we're trying to collectively solve. And I'm looking forward to working continually with you all. And I find hope in serving all of those that are on this call and the beneficiaries of the church, and trying to align what we do as a fund to church values.
Thank you. Well, I want to thank all of you panelists. This has just been great, wonderfully inspiring, and I really appreciate the time you've taken out of your busy lives, not only to be here for this hour and 15 minutes, but to get prepared for this event. And I also want to thank all the people who've joined us today. We really appreciate you participating, hopefully also being inspired. And I'll just second Christopher's invitation to join us on February 18th for our next Insights and Ideas event. So have a wonderful day, everyone. And again, thank you for coming and participating.
Thank you.
Thank you.
Bye.